Hello everybody and welcome to the very latest edition of AJ Bell Off the Road, given our current circumstances. My name is Ryan Hughes and I am the Head of Active Portfolios here at AJ Bell. And over the next 30 minutes, I'm going to give you an update on the recent market volatility, talk to you about some investor psychology and try and link that back to what we've been seeing in the market and also what we have been hearing when we've been talking to the many fund managers that we've been talking to over the last 4 weeks as this crisis has developed. So let's get straight into this with a quick agenda. As I said, an overview of market views, moods, and the main drivers, investor psychology and its impact on markets, what those fund managers have been telling us, and also I'll try and look ahead. I mean, very difficult in this uncertain period, but we'll try and just see what we perhaps think may happen over the next few months. And also, just at the end, we'll just turn to say, how can AJ Bell help you with our investment solutions and how they fit with how you maybe can put together some investment solutions for your clients. So straight away, let's look at markets year to date. Let's have a look and see how the different asset classes have performed. I mean, we all know it's been a pretty tough period for equities, and I think it's interesting to see here. What we can see is that it's actually here in the UK that has been the toughest place to be. At the time of updating these slides, just a couple of days ago, we have seen the market, the FTSE All-Share, fall 22%. I should say that all of these returns are in sterling, and actually some of the market falls have been masked by a very strong sterling, as we'll look at in just a minute. But yeah, the UK has been a particularly tough place to be, and we'll look into some of the reasons why just shortly. Right at the top there, and now this perhaps comes as no surprise, that government bonds have been the place to be in this risk-off environment, have performed well. That's both UK government bonds, UK Gilts, and indeed overseas as well. So the Barclays Global Aggregate Index there, when we turn that into sterling, is up strongly year to date. Now, interesting, I think when you look at fixed interest, is you've actually seen negative returns from corporate bonds, investment grade corporate bonds as well, and perhaps less surprisingly, negative returns from EMD, from high yield, as they've been hit pretty hard by the uncertainty. What we have seen is the S&P in the US perform well, helped by its exposure to technology stocks with that big weight it's got there, and also, perhaps interestingly, seeing that Japan has performed reasonably well relative to other markets, as the companies there are sitting on very large cash piles and have got pretty strong balance sheets, which should help them navigate some of the storms that have been occurring and are likely to occur in the global economy over the coming months. So they're in perhaps quite an interesting position to navigate the tricky periods ahead. So taking one level down to that, interesting, I think, to look at and think about what's been happening. So clearly volatility has been very high as the coronavirus has swept across the world. This unprecedented global economic standstill is happening. Clearly, not something that was high up on anyone's risk radar, high up on anyone's business continuity plan, making it very challenging for companies to navigate this. Now, what we saw and what we have seen, certainly during March, is that equity markets fell very sharply, as we just looked at. Volatility jumped to levels higher than that seen in the financial crisis. And when we equate that to market returns, then the S&P 500 index saw its second fastest 25% fall in history, only just behind the 1987 market crash, and incidentally, way faster than we saw in the financial crisis of 2008, 2009. And I'm sure many of you listening were working at that time, and that would have felt like a very savage fall and bear market. Yet this one has been actually quite a bit faster. And I think it's been the speed of it that has shocked so many market participants, given it was only a few weeks ago that the world was looking like it was going to grow at a reasonable pace in 2020, and that we were talking about some pretty strong corporate profits and some reasonably robust market returns. What a sea change we've seen in just a few short weeks. Now, one of the things that has had to happen, of course, to help economies through this, and let's just not talk about economies, of course, let's talk about the human impact of this. The people side of it, of course, is what governments and central banks are looking to support. They're looking to support their populations, and they are looking to do that in all different creative ways that they can. With interest rate cuts, of course, at central bank level, we've seen governments say that they will pay people's wages, an element of people's wages in many, many countries, including here in the UK. And of course, many other types of support that we've seen. So only just last week, the Federal Reserve announced additional support, they're actually going to step in and buy directly some high yield bonds in the market. I mean, moves that they didn't have to resort to in the 08-09 crisis, when we thought that they'd thrown everything, including the kitchen sink, at the financial system to help it along. Well, they've had to go even further here. And that, I think, has surprised many participants and actually explained some of the market rally we've seen in the last 2 weeks, really, as investors have felt that the governments around the world and central banks have got a real handle on the problem and are genuinely prepared to do whatever it takes, to quote that famous Mario Draghi phrase from a couple of years ago when he was trying to save the euro. Now, the UK, as I mentioned in the previous slide, has been the hardest hit of the major markets. And that really is to do with the construction of the benchmark. A significant weight to oils, and of course we've seen the oil price collapse, as we'll look at in just a little while, and also with a large exposure to financials, and particularly the banks, which again get hit by falling interest rates. So very painful for the UK, given the construction of the index, which of course isn't actually that representative of the UK economy. In Asia, things have been a little bit more resilient. China's been getting back to work, Korea getting back to work, and as I speak, after the Easter break, then just tentative signs that parts of Europe may be just starting to open up a little bit more, which is a positive. But certainly in Asia, they're a little bit ahead of the curve here, and that's been helpful for markets, particularly in China, where the market's been very, very resilient over the last couple of months, perhaps surprisingly so. We talked about we talked about fixed interest and the differential return that we've seen there with positive government bonds and very weak high yield, and that's rallied sharply in the last few days as the Fed has announced its stepping into the market. And of course, we may see similar announcements from the ECB, from the Bank of England here in the UK, with potentially direct bond purchases to help the market. We will see how that plays out over the next few days and few weeks. And of course, in Japan, the Bank of Japan has been buying ETFs for months, and in fact, a couple of years. They've been buying equity ETF to support the equity market there already. So we really are. Many people have talked about the Japanification of the global economy as we come through the financial crisis. That was a phrase that was around before coronavirus, and it perhaps is perhaps even more relevant now that we've got ourselves into a place where so much government support is needed for the economy, hopefully only in the short term, but obviously we'll see how that plays out over the next weeks and months. So let's dig a little deeper, looking at some of the specific issues I've just mentioned there. And this is a chart of the VIX index, so a chart of volatility over the last 15 years. And I deliberately put a long-term chart in here to encapsulate the volatility that was seen in markets during the financial crisis. And I think what's staggering to see over the course of March is just that stratospheric rise in volatility that actually peaked higher than we saw at the worst of the financial crisis in 2008, 2009. And the speed of the escalation of that volatility from such a low base, I think is also something that's really quite eye-catching. Anyone that's seen me present over the last couple of years, we've talked about low volatility and the danger of persistent low volatility and the complacency that brings. Now, of course, nobody predicted a global pandemic would be the issue that brought an end to the bull market, but clearly many investors were very complacent around the risks in the economy. and so volatility that was so low for so long has completely spiked to record levels. I should say it has actually eased off a little bit now. If we updated this chart into April, then market volatility, of course, we were seeing 10% moves in a day during March. Now that has settled right down, and now we're seeing moves of maybe 1 or 2%, and that's not actually getting market participants too excited anymore. Now, of course, back in the day, 1 or 2% move was a newsworthy event and was a relatively rare occurrence. Now it feels like it's becoming the norm. So if we look at another angle here and talk about sterling and talk about currency markets, well, the British pound has been on an absolute roller coaster in the last few weeks against the US dollar, and of course that's been driving some of the volatility in the market here. So it started. This is a 1-year chart, but it started the year at around the 130 level and collapsed very rapidly down to 115, and that was brought about by a dollar squeeze. That's a shortage of dollars in the market as everyone rushed to safety, as hedge funds had to close out because they were losing so much money, as investors sold their risk assets because they were fearful of what was going to happen, fear of the unknown really in March, and they wanted safe haven assets, and that meant buying dollars. And those dollars were in very short supply throughout March, and it was only at the back end of March that the Federal Reserve looked to increase that supply of dollars. And you saw that very rapid move, rapid rally in sterling against the dollar. So from 130 to 115, back to around 125, all in the space of a couple of weeks. Really does point to some enormous distress of financial assets in the markets. That was exactly the same was true in the gilt market. Risk assets here, you would expect gilts to tighten during a crisis as people seek safety. That's exactly what happened at the start of the crisis, when the 10-year gilt yield went from around 0.6 down to less than 0.2 at record low levels. And then suddenly, as the government unleashed this huge amounts of stimulus and people digested what it meant for government borrowing and indeed other factors going on in the economy, you saw that 10-year yield go from under 0.2 suddenly back to 0.8, and really enormous moves in the course of a week or so here, supposedly in one of the lowest risk, safest assets in the market. Seeing volatility of this magnitude really is unheard of. And then, of course, that yield has fallen right back down again to around 0.35, 0.3, where it is today. So significant volatility even in your low risk assets. Now, if we look at jobs, and this is perhaps the most startling chart that I've put together for a very, very long time. So this is US jobless claims, and I've done a 5-year chart here showing the seasonally adjusted initial jobless claims on a monthly basis, and we can see that month on month on month, it's been around the 250,000 level for the last 5 years. And of course, we had record low unemployment as we entered 2020, and then suddenly over the course of 2 weeks, just a quite phenomenal change in the figures, with initial jobless claims going from 250,000 to 7.5 million around that figure in just 2 weeks. Truly unprecedented numbers, and of course a very real risk that these numbers go even higher, as of course parts of the US where the virus continues to spread very, very quickly, and the economy continues to get shut down and continue to shrink. It wouldn't be at all surprising if we see these numbers climb further over the next few weeks as it really takes hold across the whole country. But quite staggering numbers to digest and really understand the impact that this will have on both the US economy and the global economy. The other factor, of course, we had was oil. Just not to help matters, the Saudis and the Russians decided to have a fight around oil, and we saw a 30% fall in one day as the oil prices touched $20 here. And a lot of that's to do with the OPEC trying to drive the US shale producers out of business, and so they're pumping oil like it's going out of fashion, which of course it is. But that's a separate point and a separate discussion for another day. Now, again, if I updated this chart to today, we'd have seen that oil price rallied back to $30 and then back to $20. And actually, as I speak right now, it's under $20. So significant volatility here, and no surprise that oil price is so low given global demand, and it's really at a very, very low point given the global economy has stopped. But just one final chart I wanted to look at around market performance and economics is around the dispersion of returns year to date. So this has been a theme that's been going on for a number of years, and we've talked in various presentations I've done and many market participants have talked about is the gap between the valuation growth versus value. And so this chart here is the MSCI growth index and the MSCI value index relative to the MSCI world here. And of course, the index is split into two, and so you get this mirrored effect. And we can see that year to date, growth has outperformed broad equities by 6% and value has underperformed by over 60%. Now, I think it's interesting that we started to see a flattening out of that when the market bottomed. So the market bottomed around the 20th of March, and that is really where we suddenly saw the turn that this underperformance of value just stopped. Now it looks like it's stabilised over the last couple of weeks. Now this is a trend that's been going on for a very long period of time. The reason why I include it is it's very interesting to think back to 2008, 2009, to think about what happened when we came out of that crisis. And it was value that performed very, very strongly out the back of 2009 when the market started to recover. So I'm certainly not saying that's what will happen this time, but it's what happened last time, and we do have record dispersions in valuations between growth and value that's built up over the last couple of years. So it's something that we are watching very, very carefully. Now that just is a little look back at what's been going on over the last few months. What I wanted to do now was turn and try and equate this to perhaps what you're feeling and your behaviours, perhaps what your clients are feeling, and their emotion around what's been going in the markets, but absolutely what the professional investors have been feeling as well. Now, to do this, I wanted to use a very well-known chart that I'm sure you've seen many, many times before, and people bring it out either when they think markets are very, very high or markets are very, very low. But I think it's a very interesting one to look at, and from your own perspective, almost try and say, where do I think I am in my perception of the markets? Now, it was certainly clear over the last year that markets were in that euphoria, thrill euphoria phase with all kinds of assets rallying, all kinds of alternative assets, paintings, wines, horses, cryptocurrencies, all of these alternative assets hitting record highs over the last couple of years, and everyone thinking that markets can continue to go up forever. And then, of course, things change, and they change very rapidly. Now, I think what's interesting to look at this chart is to think how quickly things change. And when we see falls of 10% in a day in equity markets, I think it's very easy to see that we very quickly reach that fear, desperation, and panic phase in March, both in equities and in fixed interest. And I think ultimately we probably did reach that level of capitulation when many people gave up with the investment markets during March. I think it was at that point that central banks stepped in to provide the stimulus, to really give reassurance to the market, to provide liquidity to the market, to help regain that confidence. Now, I am in no way saying we are at the bottom. We reached the bottom of the market and we've recovered. I think there are many, many challenges to come for the global economy and many challenges to come for companies. But I think this chart is a very useful way of just thinking about what behaviour we saw in markets. And of course, this wave might be a very long wave. It might be a very short wave. And I think over the last 2 weeks, it's very easy to see, given the strength of the rally. And let's not forget, markets have rallied 20% from their bottom over the last couple of weeks. Is that we very quickly moved into a hope, relief, optimism phase as people saw the number of cases of the virus start to to tail off in some of the worst hit countries. Now, of course, we might tip over into the euphoria again very quickly, and it might be a very short-lived emotion cycle. But I think it's a useful picture to help perhaps when you're talking to clients or when you're thinking about where you are in your own view of markets and whether you want to put your clients' money to work. This is a useful reminder. Used many times, but I think it never gets old. Now, these are very serious times for the economy and for the global population, and there's a very real human impact. But I think sometimes we can look at it in a what market participants are doing in a light-hearted way, and this is by no means to underestimate the human effect that's going on. But this is really how the market works. And sometimes when I stop and think about this, when I think about professional investors, I get very worried that this is how markets work because it really is this herd mentality. And so we've got this great cartoon, which I've used in a few presentations. Apologies if you've seen me use it before, but I think it really does show how professional investors behave when we equate it to the previous chart of emotion and how we get this herd mentality and this panic sell, and then we reach that bottom and people start buying back in. It's remarkable that professional investors at the time of every single crisis behave in the same way again and again. Now, I just thought I'd put out a very useful quote from Benjamin Graham, just to think about investor psychology. An investor's chief problem, even his own worst enemy, is likely to be himself. And I think we can all relate to that because we are talking about human emotions, and it's very, very difficult sometimes to make cold, rational financial decisions when there is such an emotional issue going on like there is in the world right now. And I thought I'd summarize that by just looking at some of the biases that we see. We see from professional investors, that we see from amateur investors, and I'm absolutely happy to say that I see in myself sometimes as an investor here. And this is from the Psychology of Financial Planning and Investing. It's a really interesting piece all around the different biases that cause us to make financial decisions that perhaps aren't quite optimal in how we wanted to behave. So confirmation bias is one we see quite often from fund managers, and in fact we see it in lots of people we talk to, where we only look for information that supports our own thinking and justifying our own beliefs. We see that quite a lot. Regret aversion and loss aversion, so people not wanting to sell losers because they think they'll come back. Again, very, very interesting given markets have fallen so fast. Well, yeah, I know it's down 50%, but I'm sure it'll recover, forgetting that it now needs to go up 100% to get back to where you started. Falling in love with your investments, something we see from our managers on occasion. We hope we don't see it, but we certainly do sometimes when we talk to managers about what they're doing. Now, hindsight bias, well, I think we could all sit here now and think, when we were reading those news reports about what was going on in China through January, and thinking, why didn't I take this more seriously? Why didn't I see the risk coming? I should have seen it. I should have been moving to cash. I should have been taking risk off. It's very easy to kick ourselves when we think something is obvious, even when it wasn't there. So we do see that, and worry, trend chasing bias, buying high, selling low. We see these things going on in markets. As I say, these are from professional investors as well as amateur investors. Everybody exhibits to some degree or another some of these biases at some point or another. So I think it's no shame in acknowledging that. I think it's actually really, really powerful and important to acknowledge that you have some of these and start recognizing in yourself when some of them are manifesting themselves. So when you hear yourself saying, okay, I think that stock, I think that investment, I know it's down a long way, I'm going to hold on, I think it's going to recover. When you hear yourself falling into some of these traps, it's to really have a good talk to yourself and think about why you're doing it, what evidence have you got to back those views up. So that's the behavioural side of things. Now, what I wanted to do just for a few minutes is just look at some of the things we spotted over the last 4 weeks when we've been talking to managers. And it really is like a little journey over 4 weeks as to how the conversation evolved Now, we've had literally dozens of manager meetings and conversations over the last 4 weeks, as you can imagine. And it really did evolve in quite an interesting pattern when we summarised our notes, looking back when we put this together over the last couple of days. Now, it was really interesting when the market started to fall, when we were talking to managers saying, well, are you taking advantage of these opportunities? Do you think some of these stocks have gone too far and it's a buying opportunity? Could you reposition your portfolio? There was a very, very clear trend for the first couple of weeks, certainly, that managers weren't doing anything at all. And that was to do with the amount of uncertainty that there was, and that we just didn't know how this was going to pan out. And so you don't want to buy into a stock that's down 20% if it's so uncertain and maybe it's going to fall another 50%. So managers were reluctant to do anything at all, and that was a consistent theme for the first 2 weeks. We talked a lot to our managers about liquidity. Now, the worst point of the market in March, liquidity was incredibly poor. Some of our fixed interest managers were telling us they couldn't even sell government bonds. Some managers were telling us they even struggled to put on a sterling dollar hedge in the currency market. And certainly managers in equities were struggling to sell equities. And when we got into the small cap space, then liquidity in some cases was non-existent. And that was a consistent theme. Now, again, things have started to improve. I mentioned earlier about hedge funds. In those first couple of weeks of the crisis in March, when it really escalated, hedge funds had to liquidate very, very quickly, which caused a huge rush for US dollars, as we saw in the charts. And I'm sure there'll be many, many more hedge funds that have to liquidate the longer this crisis goes on. Now, one of the other interesting factors we saw was ETFs. Was that ETFs actually trading at a discount, fixed interest ETFs trading at a discount, as the pricing of the ETF moved faster than the pricing of the market. Now, some of these discounts got into high single digits, 6, 7, 8% discounts on high yield bond ETFs. As market participants were able to trade these ETFs, perhaps in some respects easier than it was able to trade the underlying bonds. Now, one of the things we'll look at doing is perhaps doing a further webinar over the next couple of weeks, explaining some of the things that we saw in the ETF market. So that's just something we're exploring at the moment. So look out for more information on that if that's something we're able to put together. Now, going back to our emotion chart, fear and panic were clearly in evidence in March from professional investors. Absolutely no two ways about it. That they were happening right there. Fear and panic were there across the whole market. Now, if we move forward towards the back end of March, then we certainly saw a distinct improvement, and that was driven by central banks around the world providing liquidity, looking to calm investors' nerves, and really try and deliver some element of certainty to investors that the financial system could cope with the global shutdown. And that certainly we saw a change in the narrative. Now, one of the things the fund managers that we talked to were looking for was they were very, very focused on the data around the spread of the virus. And at the start, it was a little bit patchy, it was challenging to look at, and then it became more reliable as the quality of data improved, and people were able to start comparing maybe the UK with France, the UK with Italy, the US with Italy, and we could try and map where we were on the timeline of the virus moving through different countries. And that gave investors and fund managers some optimism to start looking forwards with some element of predictability, rather than being in that total fear and panic of not knowing what was going to happen. Now, as it came towards the end of March, fund managers were telling us they were starting to look for opportunities, and certainly these managers were starting to put some money to work in some stocks that had fallen, in their view, too fast and too sharply, and they were really starting, in their words, to try and increase the quality of their portfolio as the valuations had changed. Now, there's certainly a clear consensus from our managers that there will be a major recession. I don't think there's any surprise in that at all. Over the coming weeks, we've seen data out yesterday saying that there's a potential for a 35% fall in GDP in the UK. These are quite staggering numbers. And I think the IMF this morning, just before I came on to record this, talked about a 3% fall in GDP across the world this year. Now, clearly these numbers are very, very difficult to predict right now. But there is certainly consensus there will be a recession. There is disagreement on how long it will last. I think certain people are talking about a V-shaped recovery, others are talking about a U-shaped recovery, and then we get those that are talking about a much more prolonged recovery here. So we will see what form, what letter a recovery takes, but it's still a little bit early, I think, to really get into that. Now, just to finish summarising this point, what we also saw was fund managers moving their focus onto companies with weak balance sheets. That is, those companies that will struggle to survive this economic shutdown. And of course, the longer the economic shutdown continues, the more companies will be impacted by this. And so that is a real focus of investors right now, is saying who can survive this crisis, and who are those that are going to need refinancing, and frankly, and coldly, who are those which just simply will not be able to be refinanced because they came into this crisis with too much leverage in the first place. That is where investors' attention is right now. What do we see what do we do when we're looking at managers? Well, we're very much looking at those that have been have a good process and follow that process. We think that if managers have a good process and are able to consistently deliver that process time after time, then over time they should get a good outcome. And at various points in time, managers that have a good process, that follow that process, will have a bad outcome. But we need to give managers time to deliver on that investment process. Those managers that have a bad process, who've just been lucky, they will end up with the performance ultimately that they deserve, and that's pretty cold. But it's times like this, I think, that shakes out the good managers from the bad managers. So we'll see that evolve from the numbers over the coming months. And that's really what our investment process is all about, is separating the skillful from the lucky. It's very easy to be lucky in the short term. It is very difficult to be lucky over the long term. And that is exactly what we're trying to determine when we meet our managers, and all of the meetings that we do is trying to really drive that out. But looking ahead, as we come to the end of this this brief off the road seminar, well, clearly 2020 has started in unprecedented fashion for the global economy, with it coming to a standstill, and quite frankly, we have an unknown impact on the outlook for growth. It's too early to say what we think will happen with any degree of certainty. Sadly, some companies, indeed many companies, will not survive this impact. Others are only getting through with government support. We're seeing a mass cancellation of dividends, which is creating uncertainty for income investors. So that's something we're really focused on for our income strategies right now, is how we navigate that challenge. But I think it's clear for everyone to see that with payouts being reduced across the board, that income levels will have to fall this year. What's interesting is then thinking about how they recover and how quickly they recover, maybe next year and beyond. We're seeing early signs of progress. As I say, Europe has definitely seen some signs in the last couple of days, which is a positive, and Asia is moving forwards as well. And yields have hit those very, very low levels. We don't know the long-term impact of this, something we are very focused on right now to understand the impact on our investments. And just to briefly sum up in terms of how AJ Bell can help you, well, this is just a reminder, if you haven't seen, to look at the range of strategies that we have available for you, both on a passive and active basis, for NPS, for growth and income. And we also have the active NPS for our growth strategies, which marries both passive and active investing for those of you that are cost conscious but still want some exposure to active management. And then, of course, we've got our passive fund solutions covering the range of growth and income strategies as well. So there's a very, very wide range of investment solutions that we can help you with, mapped to a wide range of different risk providers. And we would be delighted to talk to you about any of those strategies, as indeed with any of the support team at AJ Bell. So if you want more information on what we've been doing in our portfolios, how our portfolios have performed through this period, or indeed want to read our quarterly report or listen to our webinar on our quarterly performance, then do please log on to our website and contact your usual your usual contact. So one final slide from me. Again, I've used this before. I think it's a healthy reminder that markets do not travel in straight lines. Indeed, they don't go up in a straight line for prolonged periods. They don't go down in a straight line. Volatility is normal in markets. Yes, sometimes we have heightened volatility. Yes, sometimes volatility falls to a lower level, but volatility is perfectly normal. And we're in one of those periods right now. Yes, it's unsettling. Yes, it's disconcerting for investors, for your investors, your customers. It's unsettling for everybody. It's unsettling for the human race, quite frankly. But volatility is very, very normal. It's how you behave that's important. Understanding your own behavioural weaknesses, your psychological weaknesses is key, and that's something that we continue to explore with the managers that we meet and use in our financial products. So thank you very much for listening to that. We really do welcome, are grateful for you spending the time to listen to me today. If you have any queries, questions, want to follow up on any of this, then please do get in contact. We would love to hear from you. Thank you very much, and I hope you're all staying safe, healthy, and well. Thank you.